I'm going to explain the realized volatility tab. So the first chart we have here is the volatility cone. So basically what you do here is pick out a date range. Right now we're looking at the past 1 year of data. And what we can see is the maximum and minimum realized vol for all these different windows, whether it's 1 day, 7 day, 30-day window, 90-day, 1 year window, so on and so forth. The upper 75th percentile, the lower 25th, the median in white, and where we currently are in blue. So right now we're looking at Bitcoin realized vol over the past year, and it gives us a good idea of the range that realized vol can take. So for example, in the past year, the 30-day realized vol has been as low as 25 and as high as 181. The median throughout the year has been 58. And where we currently are right now is 52, which is right about the lower 25th percentile bound, which means that 75% of the time throughout the past year, we were above this point in terms of realized vol. So what's great about this tool is it gives you an idea of the range of distribution that the realized vol can take for Bitcoin, where we are right now, and it can help you contextualize the current volatility environment. And scrolling down some more, we have basically an intraday realized volatility tool. So on the right, we basically just have price chart data. So this is the date range from September 1st to September 29th, and every data point uses 1 hour. So here I can pick out between the index, the Bitcoin index price, or the Bitcoin perp price. So right now I'm going to be looking at Bitcoin perp, and I'm looking at, call it the 240 hour or the 10-day realized vol, and then I'll calculate the 24 hour or the 1 day realized vol in blue. So I can sort of see the relationship between these two. How has 1 day realized vol kind of progressed throughout September versus the 10-day average, and so on and so forth. So it gives you a more granular look at realized volatility. Here we have a tool to compare realized vol to implied vol. So let me go to year to date. And so what I can see here is going to be the realized vol in blue versus the implied vol in pink. And I can go ahead and filter down this implied vol even more. So this implied vol is composed of the past trade data. So it's basically a weighted, trade weighted by premium implied volatility. And right now I'm making sure that's only composed with options that are out of the money calls. So I use this delta filter to go from 0 to 0.5, which is the out of the money call deltas. And I can go ahead and filter down the days until expiration. So let's say I want to look at options to have between 10 and 50 days. Call that a 30-day average. So now I'm looking at 30-day out of the money calls that have traded in the past year versus, let's call it 20-day realized vol window. And now I can see the relationship between the two. So for example, in mid-July, there's a huge gap in between realized vol and implied vol. And implied vol was trading a lot more expensive than realized vol. Or back in March when we had a big sell-off in Bitcoin, which brought volatility up a lot, you could see that realized vol outpaced implied vol a lot. And at that point, implied vol was sort of on the cheaper side versus at this point, implied vol was on the more expensive side. But most of the time they trade pretty in line. So it gives you a good idea of how those two relationships trade together. Scrolling down here some more, we have a tool to see when does volatility actually come into the market. So I'm going to go here and do year to date. So now I'm looking at the Bitcoin realized vol throughout the past year using hourly data. I could see all these points are in UTC, so I could see throughout the day what has the average realized vol been. So we can see between 4 and 10 a.m. UTC is pretty quiet for Bitcoin, but then 11 to 5 p.m. UTC is pretty active for Bitcoin. We can see the day that has the most activity. So Thursdays are the most volatile times of Bitcoin price action in the past year. So that's how that's been lining up versus Saturday, which is a pretty quiet day. And then here we have heat map is going to show us the intersection between the two. So the biggest volatile time period for Bitcoin year to date has been 3 a.m. on Friday mornings. So that's been in UTC time. That's been the most volatile time. And then the most quiet time, you can sort of see, Saturdays between 2 a.m. and 7 a.m. are pretty quiet, or Sundays between 6 a.m. to 10 a.m. are pretty quiet. And that gives you a great idea of how to trade different setups, whether you're day trading, if you're doing breakout plays or so on and so forth, or if you're trading options and you're going to be trading 2-day options and you're going to be carrying it over a weekend, you can get the idea that, okay, this could be a less volatile time for price action, so options should trade cheaper, so on and so forth. So that's a great way to kind of look at it. Here we have a probability cone. So this is very different from a volatility cone. This is a probability cone. So what we're doing here is we have the current index price of Bitcoin. So right now, let's call it 10,550. And what we're saying here is that if volatility for Bitcoin were, let's say 80. If volatility for Bitcoin is 80, well, then we could see what's the distribution of one standard deviation up or down, or two standard deviations up or down over different time periods. So right now we're at 10,500. So by the end of the year, December 31st, what is the one standard deviation distribution? So Bitcoin will be between 7,000 and 15,000, that's one standard deviation, or 23,000 and 5,000, that's two standard deviations. So it gives you a good idea of the ranges that the price can take, assuming that you have the correct volatility assumption, and assuming that prices are log normally distributed, of course. So that's a great way to kind of gauge, the price ranges that Bitcoin can take. Scrolling down here some more, we have a portfolio tool. So we can go ahead and pick out a date range, and we can pick out different cryptos from this drop-down menu, and we can assign them different weights. So let's say I want to look at XTZ and ETH and Ether Classic, a portfolio of those, and then I'm going to calculate the stats over a 100-day rollback. So now I can see, okay, this altcoin portfolio performed year to date is up 80%, whereas Bitcoin is up basically 50%, thanks to this. So it underperformed the altcoin portfolio, probably thanks to ETH. You could see the portfolio volatility on this 100-day look back versus the Bitcoin volatility on that same look back. So you can see that Bitcoin is less volatile than this diversified altcoin portfolio. You can see the correlation with respect to Bitcoin. So I could see, okay, this altcoin portfolio is between 0.7 and 0.95 correlation to Bitcoin. The beta with respect to Bitcoin, the correlation of the realized vols themselves, and then a ratio of the realized volatility. So you could see, okay, this altcoin portfolio in the past year or year to date has been pretty much always more volatile than Bitcoin. As low as parity, but as high as 50% more volatile than Bitcoin. So that's kind of the idea here, is you could trade an altcoin portfolio, hedge it out with Bitcoin options, and you use this tool to see the relationship between the two.